Hello and welcome to BST Live, the show for systematic and algorithmic traders. Glad you could join us today, where we're going to be talking about how to manage multiple trading strategies. So let's get to it. Well, good morning, good afternoon, good evening, wherever you are on this fine day, whether it's Sunday or Monday. I hope you had a nice weekend. And today we're going to be obviously talking about trading, but we're going to be talking about how to manage multiple trading strategies. And our special guest for today has been developing trading systems since 1997. He's actually been on the BST show before, way back when we were audio only. I think it was, according to my notes, early 2019, so 2.5 years ago. But it's great to have you back. David Bean, welcome. Thank you for joining us.
Thank you for having me, Andrew. Glad to be here.
It's I really appreciate you turning up today, because I know we were talking about off air how you've been feeling a little bit unwell and your family as well. So I hope for a speedy recovery, and thanks for joining us today. We appreciate you taking the time for that.
Sure, yeah.
So you're the owner of Capstone Trading Systems, and in our previous discussion, you gave us a little bit of background on yourself. But how about just for the new listeners? Do you want to just give us a quick indication of how you got started in trading and the type of trading styles that you do now?
Yeah, absolutely. I started not long after I graduated from college in 1995. Everyone was trading .com, beginning of the .com bubble, and I didn't know really much about the markets at the time. And so, I dipped my toe in, didn't really know. Then started trading futures, started studying technical analysis, and then I learned about trading systems in 1997 and started developing trading systems on daily charts, and then saw the opportunity to go intraday charts. And, it just went from there. I spent a lot of time studying a lot of strategies, testing a lot of ideas, and you find out quickly that most of what you think would work doesn't work, and the things that finally do work are oftentimes the opposite of what you think would actually work. And so so that's how I got started back in the late 90s, really, into developing trading systems.
Yep. So, I just remembered actually when I was looking at your background, you have this really nice, I guess, quote or mission statement on your webpage. And I just remembered it as you were saying there, finding some order within the chaos through strategies that beat the market. And I really like that. That really sums it up nicely. So can you talk a little bit about your trading now? Can you talk about your trading now? What do you do? Which markets? That kind of thing.
Yeah, I mainly focus on the futures markets, the major futures markets, is stock index futures. I like E-mini S&Ps, E-mini NASDAQ, crude oil, gold. Those are really some of the main markets that I focus on. Larger, more liquid futures contracts. Also focus on natural gas. Soybeans is one of the markets I like to trade. And so I developed strategies on these markets. Some of these strategies that I've developed I've had for 15 years. Some of the strategies I currently have, I've still used since 2004, 2005 timeframe is when I originally developed them. So it's nice to have that out of sample analysis right there, because you've had these strategies for this many years, and you've tested so many patterns, and there's so many things that don't work, and to have something that this works, and nothing absolutely is perfect, but hey, this continues to work, and for this market and these conditions right now. So it's neat to have that group of patterns and strategies that do work. And so I typically organize my trading into a multi-strategy approach, so that I'm trading multiple strategies using multiple methodologies in multiple markets. So that's currently how I am setting up my trading right now.
Yeah. So I guess all of that makes you an excellent person to talk about how to manage multiple trading strategies, which just so happens to be our topic for today, right? So I know.
Yeah, absolutely.
Perfect timing. So how about we start kind of a little bit at the beginning of not strategy construction, but once you've built a trading strategy, because I think a lot of people, they build a strategy and then they just they go, okay, that's good, I'm going to trade it live, and maybe there isn't so much thought about when to trade it live, what conditions, those kinds of things. So can you explain a little bit about the types of things you consider when you're looking to trade a strategy live or to start trading it live?
Yeah, you typically want to put a strategy on after it's had a losing streak, when something has done really well, and then maybe it's had a couple of losses in a row, or it depends on if you're adding it to a portfolio, if you're trading the strategy individually. But since I typically trade strategies in portfolios, I look for the portfolio to be in a little bit of a drawdown before you start or before you add positions, rather than hitting it at equity peaks, just to soften the blow for any technical errors that you make during automation, or if the strategy does have more volatility and does come towards that worst case drawdown, you have a buffer there when you start trading a strategy or portfolio strategies after it's gone through a losing streak.
Right. Okay. But how do you quantify that? Like, do you just look for a couple of trades, or do you like 50% of the historical drawdown, or is there any kind of rules that you like to employ when you're doing that?
Yeah, I have a dollar amount in a portfolio per contract that I like to see, based on how frequently it goes there. You don't want to set your drawdown amount so great that it takes 9 months to get there, or it may not get there for a year or two. You want it to have it somewhere 30 to 50% of where it goes frequently within 1 to 3 month cycles. If you see those cycles on the drawdown curve, I typically look at a drawdown curve, and a drawdown curve typically has a zero line, and when it hits that zero line, it's at an equity peak, and then it comes back, and so it's kind of oscillates. And then when you see those drawdowns, it's just kind of like dip buying a market. When you have a portfolio of strategies, it's as if you created your own market, and you're dip buying your own market, and so you can somewhat create your own cycles depending on how you arrange your strategies in your portfolio, so you can buy your own dips of your own market.
Yeah, that's an interesting way to put it. But thinking about the psychology behind that, so there's once you've decided that you're going to trade a strategy live, there's two ways it can go, right? It can keep going up profitable, and then I guess the psychology behind that is you start to think like you're missing out. But then there's also the other side, is when you are waiting for a drawdown, it's there's other psychological aspects to that. So how do you manage that psychologically when you've got two different conditions there?
Yeah, it's challenging. It depends on how big you're trading. You can start at equity peak. One of the things that you can do, and sometimes I do this, is there hasn't been a drawdown, and I missed the dip, and I really have a feel for that market environment in that portfolio, and it hasn't been on a run in a while, and it's due for a run. You can hit those equity peaks, with part of your capital, not all of it. You don't want to wait for another drawdown, and then so the psychology there, is tricky, because you don't want to chase the market. You want to buy at an equity peak and see it go straight toward the worst case drawdown, and then quit in that drawdown. And so that's what makes it challenging psychologically. Most people, what you want to do is use the opposite of what you should do. And what I've done in the past is, we've all made these mistakes where you just jump in and you get on momentum, and you want it to go. The common phrase of the day is "to the moon." You're waiting for everything to go to the moon. We're in a momentum environment with a lot of the stocks and a lot of the way people are trading cryptos and stocks. And it's that mindset. And when you compare your system, you start looking around at what other people are doing, and you're saying, "Oh, they're jumping in, and it's just going straight up for them." And I don't want to wait anymore. I want to jump in. Maybe you're comparing yourself to other people, and so you just have to kind of isolate yourself psychologically and realize that that's not the real truth long term. And so the psychology, the truth for me always helps my trading psychology when I remind myself of the truth, instead of chasing something or wanting something now, instant gratification mindset.
Yeah, yeah. So what about then if you're, you're just talking then about the cycles of how long strategies tend to have their drawdowns or between drawdowns. Some styles of trading, say, for example, mean reversion, versus breakout have very different periods of drawdown and depths of drawdown. And, you can have mean reversion strategies that go on and on and on for years without getting a drawdown. And then there's a really sharp, vicious drawdown. Do you adjust your approach depending on the style of trading or maybe even like the market conditions, anything like that?
I don't, because I'm trading portfolios of strategies, I might have strategies that, have been at equity peaks and are running for a while. And then I might have other strategies that are in drawdowns. And so, um, there's a group of strategies that I call the SR counter trends, and they didn't do that well in 2020 because they depend on waves, more wave type price action in the market.
Right.
And the 2020 price action was very V shaped instead of wave shaped. But I anticipated markets to return to more wave type patterns instead of continued V patterns. Now we still see some V patterns, but that set of strategies that I'm talking about has had a huge bounce back. And so even though it went through a drawdown, because I knew why it went through the drawdown, and because there was more volatility, I didn't just pull the trigger, maybe reduce the position size a little on that, but not, you don't want to pull your strategies that have one type of methodology when they're in the drawdown, and then keep the strategies that are doing well when they're in the run up, and then the market mode change. And so the strategies that were doing well go into a drawdown. The strategies that you cut, those are the ones that are doing well, but you're not trading them. So
yeah,
it's basically different. Some of the things I look for, different methodologies in a strategy, and I start strategies that are in a run up, and I put strategies that are in a run up with intention with strategies that are in a drawdown. I can have strategies, another soybeans strategy that I have, it's gone sideways for 5 years. And if you're trading just that one soybean strategy, you're going to give up. You don't want to just trade one strategy that's gone sideways for 5 years. But if it's in a portfolio environment and it's helping you, it's helping your correlation, so it doesn't, even that sideways price action can help your drawdowns, even though it's not making money for 5 years, then you can still keep that in the portfolio. And so that soybean strategy has actually broken out this year. And so a lot of times when this strategy breaks out, the cycle is a very nice upward equity curve. Maybe you went through 5 years of a 5-year period where that equity curve went sideways. And that's why I do portfolios, because a lot of my strategies are based on simple ideas. I know that some people, they develop strategies, and maybe they might take what I do for, say, 10 strategies and put them into one trading system. Well, I keep each of my strategy ideas into separate trading systems. And so each trading system represents a separate idea. I want my trading systems to be, I work really hard to find very simple strategies that are working now and in the past. And then, you're patient with those cycles. You manage those cycles, and with intention, you mix strategies that have different cycles and have different looking equity curves.
Yeah. So that example then of that soybean strategy that had a flat period of 5 years before it took off again. Do you have, like, if you discovered that strategy, say 4 years ago, and then you're waiting for it to, maybe have subpar performance and it just continued along, would you give it a time limit to see it prove itself, or does that go back to just looking at the cycles of the strategies?
You just, in a portfolio environment, I keep it there because the soybeans market had very low volatility. It didn't trade much. It was more of it's a day trade strategy that does well when the market trends well. And since 2016, soybeans just didn't, it's just been a less active market until the past year or so. And so I guess to answer your question, I'll leave it in there because, or I might have not had it in there and I want to add it. I might pull a strategy. Look, this hadn't done anything in 5 years, and I think soybeans is going to do well. It fits in this portfolio. I have 50 strategies in this portfolio. This is only 2% of this whole portfolio. So I can manage to have this in here without it affecting things too much, as long as it doesn't just fall apart and do terrible.
Mm.
but I have this long history here that I'm looking at, and I want to, I think soybeans is going to do well this year. Trend wise, it's going to be a trendy market. So those are some of the mindsets that I may use when trading strategies, employing strategies at certain times, is having a feel for the cycles of the market, anticipating the cycles of the market, and knowing that one strategy is not a huge percentage of your portfolio, so it can't hurt you too bad.
Yeah. Yep. Okay. Now, this is something you've touched on a little bit already, but I just want to read this quote I saw. I think it was in one of your recent emails. It's talking about the patterns that you've been and cycles you've been talking about. The quote is, "I really like the pattern cycles I see in the 2021 monthly results, uh, as they are in line with the last few years. This includes the drawdown this month." I thought that was kind of interesting to look at drawdown that way. Is that looking at it based on past performance and looking for patterns and cycles. So, can you explain a little bit more about how you apply that practically?
Yeah, this one particular portfolio is has about 40 strategies in it, and I like the way it was since 2018, 2019, 2020. They were all fairly similar month by month, and then the last few Mays, it wasn't. It was one of the worst performing months, and then this May it was one of the drawdown months. It was in a drawdown, similar to previous years, and so January's through April were looking similar, and then if you project out what it did from June through October, 2018 through 2020 looked similar in that setup. And I have previous data too as well. But this particular portfolio, the market volatility, since I would think that if you have a portfolio of trading systems testing back to 2008, if you look from 2008 to 2008 and 17, it's a little different. It's nice that it backtests, and it does backtest at that time. 2018 forward, looks like we're in a different level of volatility because prices are higher. And so if you compare those cycles, they're lining up. And so past performance is no guarantee of future results. But it's nice when you have a set of strategies and the cyclical drawdown curve is working, and you look at the monthly cycles and that's working, that's lining up. And so that's a place where if you're in a drawdown and you see that future months in the past done well, and it's in a normal cyclical drawdown, the drawdown curve looks the same, the pattern of the drawdown curve, then that's a good opportunity to risk and get in at that point during that drawdown, and to manage that risk, to take that risk.
Mm.
So trading is just a place where you take risk and you manage it, because you don't know for sure. You can't predict the future. You just anticipate what could happen and how you would manage that, and what gives you the best chance in this situation.
Mm. Right. So you're actually projecting forward what the portfolio could do, and preparing yourself. And how do you manage do you adjust anything in the portfolio for what could happen, or do you just let it play out?
No, you just let it play out.
No.
Another example is one strategy that I had, trades at night. It really does well in a market environment where the market it's a bull market, absolutely bull market type strategy, long only. And as the market was making new highs, the long-term strategy wasn't performing like it had in the past, and that spoke divergence to me. Divergence in this bull market, that these subtle micro patterns in the market are not working. And I found a better strategy that was working in the market, and I could transition that strategy into the portfolio without affecting the current drawdown curve. If you did it at the right time, you transition this in when they're both in a drawdown, or after that one's had a run up, or after the other one's had a drawdown, you transition that strategy into the portfolio, so that you're not in a situation where you wait for that strategy to do terrible, and then you're at a low point, and then you add a strategy that's doing really well, and you have to risk new capital, a new drawdown with the new strategies. So transitioning is key. Just subtle things like knowing those market divergences between what your strategy should do and what the market's doing, and it's not those kind of things can be subtle, and over time you just pick up on more and more of those patterns.
Yeah. So when you're looking at a strategy that does how it performs in specific market conditions, do you actually build the strategy for that market condition? Like, is that part of your design process, or do you look at it afterwards and say, okay, so where does this strategy shine and where does it not do so well?
I spend a lot of time watching the markets during the day, and the way I design systems is I look at patterns, and I look at patterns, and I look at them, and try to find intermarket analysis, look at market internals, and I try to find correlations. And so I test a lot of things, and so I might go days and weeks and months not finding anything new that really works. And then when you find something that works, you say, okay, this is working in this market environment. How did it do in the past? And so if it works in this market environment and it works in the past, then that is a strategy that I like to implement.
Yeah. Okay. All right, I'm just having a look in the chat. We've got some questions, and they're kind of appropriate to what we're talking about now. So how about let's look at one from Zach's posted quite a few questions. Let's take this first one. Sorry, let's take the second one. Thanks for the question, Zach. Are you looking for uncorrelated strategies to add? Actually, sorry, that's the wrong question. There's a second part. I just clicked on the wrong one. Let me put this one up instead. Do you look for uncorrelated strategies to add to your portfolio, or do you look for some other metric that improves your portfolio?
Yeah, I do look for uncorrelated strategies. My measurement of correlation has a lot to do with methodology, the way a strategy works versus a measured correlation. I don't use correlation measurements between strategies as much as I focus on methodology. If I use a very different methodology, then I perceive that to be uncorrelated. And then I measure that. I measure how it works in a portfolio environment. I test those two together and see how they perform together. If it increases the drawdown, or if it decreases the drawdown, if the drawdown's about the same when you add that to the portfolio. So I guess that's a different variation of a correlation study, is to see how it affects the drawdown when you combine two strategies.
Yeah, yeah. I suppose as well that you get a lot of these ideas from just looking at the markets, right, and understanding what's going on. So how much time you mentioned that you do look at charts and the markets. How much time do you think you need to get a feel for that kind of thing versus testing ideas?
It's something that I'm constantly learning. So it's not really. I don't really have an answer on how long it would take to do that, because it's an ongoing process for me.
Yeah.
As far as learning how to do that better and better, you want to learn how. It took me probably, from 97 to 2001 before I really, had an intraday strategy that I liked. So 4 to 5 years really of just testing ideas. You can test static data, and that I guess you can come up with ideas that, if you say, I like the RSI indicator, I'm going to try to test the euro currency. I want to see if I can come up with a strategy for the euro currency on the RSI indicator. I don't typically take that approach as much as just watching the markets, looking for patterns related to, time of day is a big one. When things happen, volume, how they happen. So those are it's basic, really. I do a lot of my ideas are pretty basic, but I work very hard to find those basic patterns that jump off the chart at me, that, okay, this is a real inefficiency in this market, and this is why.
Yeah. The reason I asked that question was, I think there's a tendency, particularly in algorithmic trading, for people to test, like the RSI example you gave there on the euro. They test these ideas, but they don't understand what's happening in the chart. They don't even look at the chart. They're just testing ideas and looking at the results. But your approach is a little different. Do you think that's something that gives your process an edge over others?
I do, because I mean, I don't know what everyone does, because I really spend a lot of time just doing what I do. And so I
Mm,
don't know what everyone does unless someone tells me what they do. And, but I do think that, what I do is based on, is having a relationship with the market of sorts,
yeah.
being in the market so much, studying it. And so I would recommend, if, to someone that was wanting to trade, that they should, um, if you don't want to risk any capital, you should trade a sim account and pretend you are trading real capital to get a feel for it. If you don't have any, if you don't have a stake in it, you don't pick up things as well. You have to have a stake in it. And
Mm,
so, if you don't have capital, the best way to do that was a sim. If you do have some capital, trade really small and try to get a feel for the market. They have micros now, so that helps to really get a feel for the market. But if you don't have a stake, and if you're just always looking at static data and back testing, I mean, I don't think I could develop as good. I don't think I could develop strategies as good that way.
mm,
I'm not saying that someone couldn't. I mean, I think people probably do and can,
yeah.
possible. But just from my perspective, I'm just sharing what works for me the best. That works for me the best.
Yeah. So when you start trading a strategy live, do you use the normal position sizing that you would use, or do you trade smaller just to let it prove itself out, or do you adjust it in any way when you start trading it?
Well, typically when I trade a strategy, I'm trading it within a portfolio. So the way I
Mm,
reduce risk is, I don't just set this strategy aside and run it by itself first to see if it works. I do just jump in
yeah.
typically when I start trading, um, I usually get in when the portfolio is in a drawdown. When I start something new like that,
Mm,
I add it when it's in a drawdown, and I've developed long enough to know that the code will not typically have errors. If it does, then you manage that. My experience with errors is they can average out over time. Some of those errors, they go against you, and then sometimes they
yeah.
go for you too. You have to remember that sometimes those, you missed a losing trade, or
Yeah.
it didn't you didn't get, maybe you missed the profit target and it's still going in your direction, and you have a much bigger gain than you would have had if you exited your profit target. So sometimes those errors go for you as well. Work really hard not to have any errors. That's the main goal. But I mean, I might be a little bit more aggressive than some. Some people that are, it can be very, 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 very conservative in this business too, and just it could test and test and test and test it on its own first, test it in sim mode. But you know, there's a lot of things I have to do, and I'm doing it once, and so I typically don't have a process that moves that slow,
Yeah.
because like I said, it is in a portfolio environment that each strategy is a small percentage of what I'm really doing.
Mm, yep. Okay. We've got a question here from Jeff, which just popped up a little bit earlier when you were talking about looking at the charts to get ideas. Jeff would like to know, are there any public forums that you get ideas, trading ideas from? And if so, are there any you can mention?
I don't spend a lot of time in public forums.
Mm,
Um, I'm trying to think. Out of curiosity, I've looked at Reddit lately, just out of curiosity, but I don't have any trading ideas from that.
yeah.
Um, the trade station forum, I think is could be a good place. I don't spend a lot of time there either.
Yeah.
Um, Books, when I first got started, it was books. We had more books in the '90s than we had forums. So I read trading system books in the '90s with Sample Code, and so Sample Code. Um, you have to be really curious and you have to be really interested in markets. I think you have to ask a lot of questions. What is true about this market? Um, interesting thing I heard the other day was from Kyle Bass, is that we live in a post-truth world right now. But you have system trading. You still have to ask what is true. What is happening right now in the markets. You need to be very curious about it. You have to want to, if you just do it because you're just, if you're just grudging away, I need to do this real quick so I can make a bunch of money, and you're not curious about the markets, then it's just too hard. It just probably won't work that well for you if if you just jump in here and try to get a quick answer, and to make money. So
Yeah, that's a really good point you make, actually, David, because I think sometimes or often what is true in the markets is usually the most, like, it feels intuitively the wrong thing to do, and so you absolutely have to test. Yeah, all the especially out on the internet, there's all kinds of crap out there which you need to validate yourself. So I think you touched on a really good point there, in trying to determine what is actually a market truth or not.
right, yeah, lately a lot of things that haven't been true in the past are true, and so it's tricky to if you're learning the markets now, what you think is true now might be true now, but it's not
Yeah.
typically true, and so just be careful.
Yep. Yeah. All right, we got some more questions here in the chat. So let's here's a good one from Ola. G'day, Ola. Good to see you here again. Ola's a regular. In a multi-strategy environment, you would expect a smoother equity curve. Does that mean that you can allow each strategy to be less smooth and can use strategies that are less complex?
Absolutely, that's a great question. That's exactly what I do in my last webinar, and one of the things I talk about in some of my webinars is the ugly equity curves, combining ugly equity curves, because each strategy is, a real trading system is not that exciting once you get down to it. Once you've tested everything, once you realize that, you're looking for this great strategy, you keep looking for better and better strategy, and you realize there's just a limitation to what you can do in a trading system. And any single trading system, if it's unoptimized, if it's not curve fitted, and you add slippage and commission, it's going to have some drawdown in it. It's not going to look, it's not going to look great. I expect my systems any given system to have 1 to 2 years drawdown in it at some point. In like the soybeans example, 5. And so that's exactly why you want to combine. That's exactly why you want to combine strategies in a portfolio, because if you keep chasing the concept that just going to find this strategy that that works great, I'm just going to find still people know the Holy Grail is not true, but they still kind of chase it. They still think that they're going to subconsciously they're going to get there by seeking that Holy Grail, and you just have to learn to be comfortable in the fact that, hey, these are not perfect. These are ugly equity curves. This is a normal trading system. If you look at any equity as it rises, it has an ugly equity curve, and it's the perception that you think that, I've got a VPS, I've got real-time data, I've got a fancy algorithmic trading platform, so I can engineer straight line equity curves with one strategy, and even you can't. It's just not going to happen. No one's ever done it, and I don't think anyone ever will. And you're going to have drawdowns, you're going to have flat periods, you're going to have frustrating periods. I anticipate my strategies to make worst case drawdowns. I anticipate my portfolios to make worst case drawdowns, and we treat our portfolios in such a way so that you start trading them in a drawdown, and then your goal is to get some continued out of sample performance in that when you start trading it, and then use that worst case drawdown as kind of a trailing stop loss. And so you're if you have a portfolio that has a $20,000 drawdown and you start trading it in a $10,000 drawdown, your goal is to maybe risk 15,000, so 5,000 past that worst case drawdown, and then you anticipate trying to get some out of sample performance of 20 to 40K, and then use that worst case drawdown, and use small drawdowns to maybe add contracts if you have the capital. So maybe you didn't start with your full amount of position sizing until you already had some profits. So it's exactly right. Ugly equity curves. You can let things run against you a little bit, and you don't put all your energy on one setup. It's so draining and frustrating to keep trying to find that one strategy that works great, that satisfies you. And so when you combine those portfolios, you get a much, much better approach if they're developed properly. But those portfolios still have drawdowns too. They're not perfect
Yeah.
either. So nothing is perfect in trading, and you have to learn to be comfortable with uncertainty. You have to have a way. You have to way to manage your risk by starting in a drawdown, and then knowing how to transition portfolios. Is if the markets do change, or if that strategy stops performing, and if volatility was the biggest factor I see that changes a portfolio, if that changes by either increasing significantly or decreasing significantly.
Yeah. Yeah. Well said. And there's a follow-up question here from Ola, which asks something you just touched on a little bit there. When you optimize a strategy in a set, would you prefer to maximize straight return instead of risk-adjusted return?
I don't optimize. That's the thing, is I don't use optimization tool. So I develop strategies based on patterns, and I don't. I get that question a lot. How often do you re-optimize your parameters? I change systems. I might change systems. I might say, the volatility's doubled. I need to double the stop loss, or this market's choppy. I need to add a profit target to this strategy. I don't. A lot of times if I do use an indicator, I'll use probably 12. The number 12 is the look back, or 24. I'll manually try some things, but I don't go in there and that's one of the things I do to try to keep the strategy pure, is to not run the optimization tool. If I do use an indicator, if I do use a pattern, if I want to look back 3 bars or 5 bars or 12 bars, or what makes sense to me based on what I've observed, versus just completely treating the market as data set as a scientific. It's not completely scientific to me, so I don't try to formulate. I don't want to formulate a strategy such that it matches the market exactly. You could probably take my strategies and make them a lot better, and so yeah, they're just loosely fit ideas. And I fight really hard not to use that. And I don't use the optimization tool when I develop a strategy.
Yep. Okay. Thank you. So we've got a couple of questions here about allocation to strategies. I'll post this one from Sam. Sinan also asked a similar question. Please discuss how you approach allocation to each strategy and how that might change over time.
It's really if you have a list of 40 strategies, you trade one futures contract to each. And I'm not doing position sizing within the portfolio of a straight line portfolio. If you take like a 40 strategy portfolio, you need at least $200,000 to trade that. And so I don't typically change, unless you're talking about, okay, I'm going to trade 400,000 now. I'm going to trade 2 contracts of each strategy, or 600,000. Maybe I'll trade 3 contracts of each strategy, or maybe I'm more risk averse as capital increases and I trade, I'll wait 700,000 to trade 3 contracts. And so that's how the position sizing works, portfolio as a whole for me. And I like to add contracts on drawdowns. If you're above a certain point, you add contracts on a drawdown.
Right. Okay. So you don't consider that some markets or strategies may be more volatile than others, therefore they have, I guess, a bigger impact on the portfolio as a whole. Do you look at that?
They do. Some markets do have more volatility on the portfolio as a whole, but I don't want to add that volatility parameter to my portfolio, because volatility can change. And so it's another parameter for me that could potentially cause greater curve fitting when you add position sizing at that level. That's how I do it. You see the S&P, traded an 8 VIX in 2017. And if you if you increase your contracts greatly on that, and then you get 2018, it happens fast, and you're trading too many contracts and you have to scale down quickly.
Yeah.
And then it gets small again. And then, gold volatility is low, and then it expands quickly. You have to have another algorithm to then adjust position sizing quickly for volatility changes that, for me, volatility changes so quickly. It's hard to come up with a position sizing algorithm to change it quickly enough. So I would rather trade multiple strategies, one contract each, that trade different methodologies, and that, to me, then I manage the portfolios. The equity curve of that is managed by how many contracts I trade for each strategy. So the volatility is managed within the portfolio
Right.
of the equity curve of the portfolio.
Yep. Okay. Well said. Thank you. Here's a question from Arthur. Welcome, Arthur. Do you look at the return skew of new strategies to obtain a positive skew over your portfolio? For example, adding momentum strategies to a portfolio made of mainly mean reversion strategies.
Yeah, I mean, when I first started, maybe this answers your question. I used more momentum when I first started.
Right.
So I had to fight harder to find more counter trend and more mean reversion strategies. So that was a weakness when I first started, was I had too many trend or momentum strategies, because that was what was working then, and volatility was expanding more when I first started. So I do add, I try to balance the number of trend and counter trend and mean reversion type strategies for that reason, because just like volatility, markets change so quickly. I don't yet have a way to say, okay, now all of a sudden just jump to this strategy or position size, so that you're trading more trend and less counter trend, or more counter trend and then less trend. It just comes out of the blue so quickly that you already have to kind of be there. That's how I do it. And so I do try to balance it like that. And so right now, probably my bias in some of my stock indexes is still more long only strategies, as long as whether you agree with the Federal Reserve or the central banks policies right now, you can't, it's hard to go against it. So even if you don't agree with it, you just trade it. It's like, okay, shouldn't go up, but it is. So I'm a trader, and I'm just going to do this. I'm going to trade more long strategies right now. And so, yeah.
Yep. Okay. Thanks, David. Here's another question from Zach. Zach's got lots of questions today. Thank you, Zach. If your development is focused on strategies that are happening right now, how far back do you test your strategy to validate its effectiveness before you put your money behind it?
That's a good question. I've had some strategies that recently I would test, and my concept was I'm gonna trade strategies that work now and that work 15, 20 years. But then I want to, then I have other strategies, a few strategies that work maybe 3, 5, 8 years back. And then I've gotten as short as 1 year, but that doesn't, 1 year, those have been some fails, I guess, if you just look back and say, okay, this works the past year. And that hasn't been probably as good of approach. 3 years, 3 to 5 years is what I like to look at least. And I love that I have a set of strategies that do work, 2009 and before, a group of strategies that I've carried forward over time, that I know I can count on these strategies longer term, not always in the short term. Sometimes they disappoint me in short term as you go through drawdowns, but then you see new patterns, and you really, you don't want to miss out on this inefficiency. So I have taken the approach in recent years. Okay, here's an emerging pattern. I see this a very strong pattern over the past year. Can I just trade this one strategy right here, mixed with all these other strategies that have longer back tests? And so, I don't do that as much anymore. I would like 3 years, and typically 5 or more, mixed in with my strategies that I have had 15 plus years as well.
I guess 15 years back, some of the data is pretty sketchy. How do you account for that in your backtest results?
Yeah, I mean, some of those strategies that I'm talking about, say for example, the stock index futures, those, you have pretty good data in the S&P back to 1997, 2001 timeframe for the NASDAQ. And so the data that I have is good. It's different. The market is different, but if it works over that time period, it's really it's positive that it can work to 1997 and it works now. And so, and then the other markets, it is tricky because micro Bitcoin futures just came out, and so you have less than a month of micro Bitcoin futures. You don't have enough data do you look at cash Bitcoin to develop a strategy there? And for me, it's no, not yet. But and then a lot of the commodity markets, they went electronic in between 2006 and 2008, and so some of those strategies back to 2008. I only have reliable data back to 2000, what I would consider reliable electronically traded market data back to 2008. And then some of those I've gone back, I have a strategy in soybeans that tests well to 1984. It's a swing trade strategy, and I test on the pit data. So you can test on, if you have pit data or cash data, you can test strategies on that data. And then that's just further validation. It's not required really. If I have a strategy that works since soybeans electronically traded, if electronic start of soybeans, it works from that point forward, then I'm pretty happy with it. It doesn't have to work back to 1984. It's just some of those strategies I've had before the grains went electronic. So some of these strategies I've had before these commodity markets went electronic. So you've had to adjust them. If you, for example, the start time was different. Some of these markets have changed their start times. They're more active now at night, and so you have to take those things into account.
Yep. We've got a couple of questions in the chat here about the tools that you use. So let's try this one from Mike. Excuse me. Do you use Portfolio Maestro on TradeStation or another platform? And is your strategy development in TradeStation Ninja or something else?
I develop my strategies in TradeStation. I like the ability to quickly backtest ideas, easily programming them, and I export the data into an Excel spreadsheet for each strategy, and I do a combined equity curve analysis on an end-of-day basis for my portfolio development. That's the most efficient way that I've found to do that. Portfolio Maestro, I've used that before. It just took me longer to get everything working in that. So in Excel, it's a very fast, efficient tool for me. Once I've exported the data, have it in Excel, have each column is a different daily P&L, combine those, look at the drawdown curve, and then I can quickly add and remove strategies to see how they're correlated. If you take all trend strategies in the ES, how does that look? All trend strategies in NASDAQ, how is that looking? And you combine those, how does that look? And it updates quickly in Excel as fast as you can change it, and as fast as your Excel will perform versus, a lot of these portfolio tools, if you do one change, then you have to run the portfolio tool again, and it can take, several hours just to do one change and see how it works. So I've used multi-charts, portfolio backtester as well. That's pretty good, but you make one change, you have to run the whole thing again. And so I used NinjaTrader before to do, market replay. I was trying to develop a strategy based on market depth data, order book data, and you can't do that in any of the platforms because market depth data isn't recorded historically, but you can download market depth data from NinjaTrader and do back tests on market depth data. It's pretty involved. And so I've never come up with a good strategy based on market depth data, level 2 data yet. So I mainly use TradeStation because it's fast to program, and I use Excel because it's fast. And then, when you're looking for the truth, we're talking about the truth. You have to you ask a lot of questions. You got to have the answers quick. You can't just wait a long time and then ask another question, and then wait 3 hours and ask another question. You'll never finish. You have all these questions you'll never get answered.
Yeah. What about in live trading as well? How do you? What platforms do you use, and how do you? Excuse me. Sorry about that. What platforms do you use, and how do you trade multiple strategies on the same symbol?
Yeah, that's a popular question. You know, in TradeStation, you can do that. You can trade multiple strategies on the same symbol. Um, you tell the chart. There's a chart setting in there where it enables it, and that's probably one of the most confusing things that was confusing for me at first, but is confusing for a lot of other traders. But it will every time if you do that. There's two different settings. You don't use the adopt real world if you're trading multiple strategies on the same symbol in the same account. You use the first setting, and you basically all your long trades are you put a +1 in your mind. All your short trades are a -1, and you add those up. It's just Boolean. If you have 10 strategies that are long and you have 3 strategies that are short, you're now long 7. Now long 7 in the real world, and your trades aren't going to offset the way they are in your strategy. So if one strategy goes long and then another strategy goes short, in the real world, you just took a long trade. You just took a trade, and that trade is over and you're flat. But on your chart, one system is long and the other system is short. And then for the example, when that short system exits, it buys again. And then the long system exits, it sells again. So you have 2 different trades in the real world that look different than your signals. But you just have to get used to that. You have to rehearse that if you're new to that, and you'll pick it up pretty quick. It's pretty quick. I look at my charts. I keep each market in a different chart, and I look at each chart and I quickly scan what my net position should be, and I look at it, and it matches. Every now and then you're going to have a technical error, and you correct for that when you have them.
Yeah, sure. Okay, a question here from Jones. G'day, Jones. Good to see you here again. Do you use genetic algorithm software to help you find strategies?
I'm not familiar with the genetic algorithm software, but I've never used that. You know, it's always whatever you can find, book, forum, software to come up with a strategy idea, whatever makes you curious, whatever motivates you, could be a good approach for anyone. For me, it's watching the markets and seeing how patterns unfold. Sometimes forums are good. Sometimes books are good. There's probably things that I'd probably like forums if I was in them, but I just haven't been in them as much just due to time. And so, I would think that you could probably use a software to give you good ideas and test those. Just be passionate about it and work hard at it.
Yep. Okay. Here's a question from Jeff about trading during news. Do you trade during news events like when the Fed speaks?
Yeah, I don't filter my systems for the Fed. They are more and more active, and they used to be a big deal when the Fed spoke. Now the market doesn't move as much, and when the market does move a lot lately, it's usually an unplanned event. So you can't program a system to stop trading during an unplanned breaking news. You could program the system to stop trading if there's volatility spikes, but I don't do that. Sometimes I wished I did, and then other times it works out too, because I haven't tested this in a while, but I did run the tests a while back, and it didn't make the systems much better or much worse to sit out Fed days. So I haven't done that system recently. I haven't done that test recently. And so if I did that recently, it could be the last 3 years that if I sat out Fed events, the systems would be better. But what if that mean reverts? What if the previous 3 years it worked better during Fed events? The last 3 years it didn't work as well during Fed events. Then you added another rule to your setup, and then you stop trading during Fed events. And then those are when your systems could do well. Maybe you have a trend following system, and maybe the next 3 years Fed events spawn great trends. And so I trade during Fed.
Yep. Another question here from Zach. Zach's on fire today, which he just touched on a little bit about failing patterns. Do you retest failing patterns? See how they're doing?
I do. I have patterns that I keep track of. I have probably more patterns than more trading systems than I can keep track of without. I wish I could have every strategy I've ever developed open on my computer at once, but it would crash it. So many times over. And sometimes I put systems on shelves, and I come back and I'm like, why did I put that one on the shelf? It's doing great. And so I've got this old strategy from years ago that's doing great. And so that happens sometimes.
Yep. Okay. Just quickly scanning the chat. We had a question from RDE about research ideas, which we've covered already. There's a question here from Devil Trader. Let's see what Devil has to say. About your ideal robust strategy. What is the win rate or Sortino ratio? Or, perhaps we should broaden that question to what are you looking for with your ideal robust strategy as far as metrics?
I'm glad you asked that question. It's something I've been thinking about lately. One of the one of my favorite approaches is to take a strategy that loses a lot of trades, that has a low winning percentage. Some of my favorite strategies are, lately around 20 or 30% of the trades are winners. That means that you're cutting your loss to short and you're letting your profits run. And it's counterintuitive to our educational system. You're supposed to be right 70% of the time to pass your classes. And you want a trading system that's right 70 to 80% of the time. But, and I do too, I would love it if I could have a strategy that's right 70 to 80% of the time and had big winning trades and also traded frequently. You could have a strategy that is right 70 to 80% of the time, that has big winners, but it probably won't trade very much. And so, but seriously, I like to, that's part of my diversity, is to have a diversity of methodologies such that those numbers they go across the board. They have strategies that do actually have higher winning rates. Most of my strategies don't have more than 58 to 60% winning trades. Some do. I have a few that are in the 70 to 80%, and then I have some that are down in one of the last ones one of the lowest percentages I've seen lately is about 22%. One of my favorite strategies lately only has about 22% of winners in the last year. It's a NASDAQ strategy that uses a $300 stop loss. As you can imagine, trading the NASDAQ with a $300 stop loss, you're going to have a lot of losers because the NASDAQ moves a lot. And so I'm happy to trade the NASDAQ with a $300 stop loss if it can get you some good trends in it. And so that's why I say that, because it's counterintuitive, because you don't want to. It's hard to trade a strategy that has a lot of high percentage of losers, especially if that's your only strategy. So going back again to diversity, you have those. Sometimes you put those strategies in there with high winning percentages just to help your psychology, even though they may not make as much as some of your strategies that capture the big winners, that are between 30 and 40% of the time they have win percentage 30 to 40% of the time.
Yeah. And so just touching a little bit more on trade frequency there, M Squared just posted a question as you were talking about it, actually, so it's good timing. On average, how many times do your strategies trade per week? I would think with a multiple strategy portfolio, you would be okay with very low frequency trading strategies. So what are your thoughts on that?
Yeah, that's exactly right. A lot of great questions today, really asking the right questions. Low frequency is definitely what I do. Sometimes some of my strategies, that's one of the reasons why I trade portfolio, because some of my strategies may not trade for 2 or 3 months. And then sometimes I have a strategy some of my strategies that trade, a lot of times I set them to trade only one time per day at most when they do trade. And sometimes those strategies, they'll trade once a day for the entire week, 5 trades this week. Other times they may not trade for 2 or 3 weeks, or maybe they'll trade 1 or 2 times in a week. And then, but it's hard for me because I tend to be the type of guy that just wants to jump in and do a lot of stuff, be aggressive. Tend to err on the side of maybe being a little more, especially when I first started, being a little more risk averse, or not risk averse, but risky, or as opposed to risk averse. Going with the saying that there's old traders and there's bold traders, but there's not many old bold traders. So I'm with you on the low frequency. And then when you add that portfolio of strategies, you have you increase the number of trades, so you're actually trading enough to satisfy you as a frequent trader, as an active trader. If you're trading, you typically, if you're there all day, you typically want to see 3 to 5 trades a day. And so that's typically where my trading is in the portfolio is 3 to 5 trades a day, sometimes 10 and sometimes 15, sometimes just 2 or 3. There's been times when there's been none, but low frequency on each individual strategy. Each individual strategy is definitely the key, because you have slippage and commission to overcome. You want to make sure your average trade profit is high enough, and you can't trade all the time and have a high average trade profit. I've not found a way to do that.
Yeah. Okay. All right. Well, we might just wrap up with one final question here, David, because I'm conscious that we're just about out of time. So this one's from Mike. It's another TradeStation question. Do you use TradeStation automation for strategy orders? Have you had any challenges with their technology in the past year or so?
Yeah, I use TradeStation automation, and I have, every platform that I've ever traded with. There is no perfect trading platform, in the same way there is no perfect trading system. And it's frustrating when you have money on the line and you're trading, and there's been disconnects. But yeah, that every broker I've ever dealt with, every platform I've ever dealt with has had those disconnects, has had those technology issues. And I don't know that you can get into something with this much technology and never have a perfect technology set up at any broker, any platform, anywhere. You just have to manage that. VPS, use a VPS, but even if you have a VPS could go down. A brokerage connection go down. The exchange, we've seen exchanges go down. I haven't seen that in a long time, but you could have an exchange outage at some point and be stuck in a trade, and you can't offset, and there's a gap intraday. I've seen intraday gaps with exchange outages many years ago. Usually when that happens, there have been limit moves in the markets. The exchanges, we've learned more. We've been reminded of the fact the CME can reject market orders in fast markets, reject stop orders in market orders. Back in pandemic days, you saw a lot of limit moves, and the CME is rejecting stop orders in market orders. So you have to be there. You have to be prepared for those sorts of scenarios and trade around those, because there's nothing perfect technology wise to get you out of everything. And once again, I think sometimes those things will go in your favor. Position sizing would be key. You want to make sure that you trade small enough so that horrible day would not wipe you out.
Yep. All right. Well, I'm conscious of our time here. David, thank you very much for chatting with us today. It's been really enjoyable, and we've had a lot of great questions in the chat as well. So thanks for the participation, the audience participation. So if people want to learn more from you or get in touch with you, David, how do they do that?
You can email me, david@capstonetradingsystems.com. Go to my website, capstonetradingsystems.com. Contact information there, and that's the best way to get a hold of me. Appreciate it. You having me, Andrew. I've really enjoyed this interview. I think you have a great website, great service to the industry to interview traders and do what we're talking about. Bring truth to the subject of trading and realistic expectations. You do a great job of that, and appreciate being able to be here. Thank you.
Oh, thank you very much, David. I appreciate your kind words there, but this show is all about all the guest traders who come on. So, it's been great chatting with you today. And also the past episode, which I mentioned early on, is episode 161. So if anyone wants to go back and listen to that, that was another great chat. Just go to bettersystemtrader.com/161. And that was 2.5 years ago. So if people want to go back and listen to that one again, I'm sure you'll find some good nuggets there. And so now we're getting some thanks coming through on the chat. Let's just share some thanks from the audience. So M Squared said, thank you very much. RDE, thank you. Arfa, g'day Arfa. Thanks for the question earlier. Great session. And here we go. We always thank the guests. So thank you. And There's a few more here. Let's quickly get through these here. Devil Trader said thanks. Mike said thanks. Okay, there's more coming through. I can't keep up now. So, yeah, thanks again, David. We really do appreciate it. And take care and all the best.
Thank you. Thank you, Andrew.
All right, cheers. Thanks, everyone. Cheers.
All the
Bye.
best to you. Have a good
Bye.
night.